Hello and welcome to another stock analysis on Stock Market Palantir. Don't forget to put your comments and subscribe. Okay, now let's go hear our analysts.
Welcome to the Stock Market Palantir. Today we are going to talk about iBio. iBio is just one of those really fascinating and frankly kind of painful case studies in microcap biotech. We're looking at a company that's done a complete 180, a really radical pivot away from its old capital-heavy business, the fast farming CDMO model, into, well, a pure-play AI-driven drug discovery company. And their focus now is almost entirely on that explosive cardiometabolic space.
25. The stock is just hovering around $1.20. It's just stuck. But the volume, that's the interesting part. It's high, averaging something like 850,000 shares a day. And we just saw that crazy volatility spike around the obesity week data, right? And then boom, an 8% drop right after the Q1 earnings report, a $5.7 million net loss.
Right. And that price action, it perfectly captures the whole dilemma here. The central question for anyone looking at this is whether the new strategy, the stability they've found, and the potential in this pipeline, the real lottery ticket, if that finally outweighs the structural baggage, and it's heavy baggage. We're talking about a history of just severe shareholder dilution and a really restrictive market structure. My position is that the forward-looking science, the AI platform, that's what matters now.
See, and I just can't agree with that framing. I'm coming at this from the complete opposite direction. To me, the pivot is almost irrelevant. If the company's capital structure, its very DNA, is fundamentally designed to destroy long-term value. I mean, that's what it's done for a decade. This history of delusion, the deep-seated market skepticism, that's a structural sickness, and I'm not convinced even breakthrough science can cure it.
My whole thesis, though, is built on the idea that management has finally done the painful work to stabilize the ship. By becoming a pure-play discovery company, using this advanced AI stack, with proprietary stuff like epitope steering and their stable Hue platform, they've moved from low-margin contract work to high-multiple drug ownership. We're talking about their cardiometabolic assets, iBio 610, which is an activin E antibody, and iBio 600, an anti-myostatin antibody. And the science behind iBio 610, this is the kicker. The non-human primate data from Obesity Week suggested a half-life of over 33 days. Now, if that translates to humans, we could be looking at a half-life of up to 100 days, a twice-a-year shot. I mean, that is a commercial game changer, and it alone justifies a market cap that's only sitting at, $27 million? Plus the recent $50 million offering. That extends their cash runway all the way to the fourth quarter of fiscal 2027. The immediate threat of just going under, that's off the table.
Okay, that runway buys them time, I'll give you that. But it doesn't just magically erase the company's DNA of dilution. You can't just ignore the trauma here. Let's talk about the retail investors. The cumulative reverse split, a 1 for 5,000 ratio over the last decade. That isn't just a weird statistic. It's mathematical devastation. It created this permanent class of what people call bag holders, and that creates this constant headwind, this skepticism you see on every single forum. And that leads directly to this bizarre valuation paradox we have now. They have almost $50 million in cash, very little debt, and yet the company trades at a negative enterprise value, roughly negative $19.5 million. This isn't just a low valuation. This means the market is literally assigning zero, or actually less than zero, value to their entire pipeline and management's ability to do anything with it.
But that negative EV is exactly what creates the asymmetrical bet. Let's get back to the real value driver here, the science. The NHP data for iBio 16010 is so promising because it's designed to fix the biggest long-term problem with GLP-1s, which is muscle wasting. iBio 16010 is aiming for fat-selective weight loss by targeting activin E. This isn't just another appetite suppressant. It's a different mechanism that could lead to much better body composition outcomes. That premise alone is what validates the whole lottery ticket idea.
I get the science. I really do. The potential for a fat-selective mechanism is interesting. But, scientific promise is cheap. Clinical execution is incredibly expensive and risky. The market's reaction after Obesity Week tells you everything you need to know. It was a classic sell the news event. If that NHP data was a true de-risking event, the stock would have exploded upwards, but it didn't. It shows you exactly how the market feels about preclinical animal data. It's highly speculative, and where's the validation outside of this one animal study? So many drugs look great in primates and then just fall apart in human trials.
That's a fair point. Clinical risk is always there. But look at what management is doing. They're demonstrating commitment here. Their recent move to consolidate the full global rights to both of these drugs through AstralBio, that shows you they aren't just running a science fair project. They're setting the table for a potential partnership or even a buyout down the line. They're locking in the economics now, which is a huge signal that they actually believe in that 100-day half-life.
Strategic moves are nice, but intent doesn't pay the R&D bill. And let's get back to that financial runway and the ever-present cloud of dilution. Yeah, the cash lasts until fiscal 27, which is a luxury for them, but the existence of that active, at-the-market, or ATM equity facility is the real structural threat. That ATM lets the company just bleed new shares directly into the market whenever the price gets any momentum. You mentioned R&D spending surged to $3.6 million in Q1. That's a huge year-over-year increase. That burn rate is what they need to move forward, but it also creates a relentless need for more cash. And the ATM is there precisely for that. Anytime this stock gets some real upward momentum, say it pushes past $2, that ATM just acts like a lid, a constant supply overhang that structurally caps the rally. It ensures that long-term holders almost never see that sustained appreciation they're hoping for.
I see the ATM as necessary financial prudence, not some guaranteed death sentence. It's a tool for controlled, opportunistic fundraising, which is, frankly, way better than the catastrophic emergency offerings or those destructive reverse splits they used to have to do. The cash they have now stabilizes everything. It shifts the entire narrative away from pure survival and towards clinical execution. I mean, they got their NASDAQ compliance back in November, so the immediate threat of a reverse split is gone. Now, all that matters is making sure that $3.6 million in R&D spend actually translates into good data. The ATM only becomes a major threat if they execute poorly.
I'm just not convinced it's just a tool. I think it's more like an unavoidable tax on holding this stock. But okay, let's shift gears completely. Let's talk about the trading mechanics, because they fundamentally warp the valuation here. You have to look beyond the lit exchange where most retail orders happen. The market microstructure is a huge and often overlooked problem. So if you look at the FINRA data, a massive chunk, somewhere between 47 and 60% of the daily volume happens off-exchange, in dark pools or on TRFs. For the average investor, what this means is that price discovery is being distorted. When a flood of retail buy orders comes in on good news, those orders are often just internalized by wholesalers, neutralized before they can even put upward pressure on the price on the public exchange. And this whole structure, it just fuels insane volatility. We saw a huge spike in failures to deliver, FTDs, right around Halloween of 2025. Over 565,000 shares. That's the kind of stuff that gets Reddit buzzing about a short squeeze. But my argument is this whole ecosystem is really just built for professional traders to play the volatility. It does very little for the patient long-term investor who's betting on the science.
I disagree with that conclusion. I mean, high off-exchange volume is pretty typical for a stock like iBio, a high-turnover microcap. It doesn't automatically mean something sinister is going on. It can actually indicate strong retail interest in the new obesity story. You have to be careful to distinguish short volume from actual short interest. A lot of that high short volume, and even the FTDs, it can just represent market makers providing the liquidity needed to handle all the retail buy orders. Think about it. When retail traders pile in, market makers have to fill those orders instantly. They often do it off-exchange, and then they cover their positions later. That process, it looks like high short volume and can cause temporary FTD spikes. But what it really suggests is an active turnover in the shareholder base. You have new people buying the GLP-1 story, and the market makers are just facilitating those trades. It's not necessarily some big, institutional bearish bet.
Okay, I can see the market maker perspective, but whatever the technical reason, the result is the same. The stock becomes a pure volatility vehicle, not a growth story. And that brings us right back to retail sentiment. In spite of all the exciting new science, that historical bitterness, it's just a permanent headwind. The people who were wiped out by that 1 for 5,000 split, they're still out there. And they call the company a scam, a dilution machine. Every single time the stock starts to run, you see them pop up, warning new investors, many of them just hoping to get back to break even. That polarization makes the shareholder base incredibly unstable. It means the stock is totally dependent on a binary, all or nothing outcome, a huge clinical success or a total failure. There's just no room for small incremental wins. That makes it a pure gamble.
But that baggage and that negative enterprise value, that is precisely what creates the opportunity. It's what attracts the new FOMO-driven buyers. Think about it. Why would a big pharma company buy this pipeline right now when the market is literally giving it away for less than free? They wouldn't. But an investor who sees that a $27 million market cap for a piece of a potential multi-billion-dollar market, they see an insane risk-reward setup. The narrative has finally shifted from that dead COVID play to the high-potential GLP-1 speculative thesis. And that's pulling in a whole new group of people willing to make that binary bet.
The problem is that the legacy mechanisms for capital destruction, they are all still in place, just waiting to dilute any significant price increase. It requires an investor to completely ignore a decade of history and put all their faith in the flawless execution of a single early-stage trial.
At the end of the day, the unique commercial potential of that 100-day half-life for iBio 610, that is the single shot on goal that defines the value now. The strategic pivot gave them the stability, the focus, and the R&D budget to finally take that shot. The past is just historical data. The future is all about clinical differentiation.
And I'd argue the market structure and the legacy of dilution are powerful structural forces that will be there every step of the way. And those forces will erode capital if that clinical timeline slips by even a little or if that ATM gets used heavily. Ultimately, investors have to decide which story they believe is more powerful, the potential of a scientific breakthrough or the long, destructive history of this company's capital structure.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights and see you in the next video.